Hello, ladies and gentlemen. Or should I say good morning, good afternoon, and good evening? I think mostly good morning. My name is Marek Smolinski, and I'm a producer here at Opal Group and IA. And you've guessed by now, I'm sure, that I will be your MC for the day. And as your MC, I am so pleased to be the first to say welcome and thank you for joining us at Opal Group's first ever, our inaugural Virtual Emerging Managers Summit. For those of you who've attended our previous virtual events in the past, I said this then, and to those of you who haven't worked with us in the past, and for those of you who did, I said this before, but this was never in the plan for us. I'm sure we've all said that at some point, but this wasn't in the plan for us. This is not how we thought we would be facilitating communication, collaboration, or even some of the formation of ideas or solutions. And yet here we are. And we're here not only because of Opal's incredibly talented staff, but because of all of you, our audience, our presenters, our speakers, our sponsors. Everyone here saw the need to pick up on some old conversations and the need to start new ones, which is why I'm so glad and thankful you could all join us here today. Me personally, I have been with Opal for about half a decade now, and over the course of that time, I've had the privilege of meeting many of you who are logged on today. But for those of you whom I haven't yet met, I do hope we have the opportunity to meet and work together in the future. Hopefully at some destination conference, maybe in 2021. Once again, I do want to thank everyone here for joining us as we we take this new venture and how we transition our events to a virtual platform. I do hope that we are able to meet safely, at our live events again soon. But we're here for the Emerging Managers Summit, and the overall goal is to highlight the benefits and opportunities for institutional and private wealth investors to invest in new, small, diverse, women-owned, emerging, and boutique fund managers. This program seeks to bring, smaller, diverse managers into the limelight as they have historically outperformed their larger peers. And, we're going to touch upon those specific areas and under that umbrella during each of our panel sessions, I assure you. I do want to say I hope you and your loved ones are staying well, staying healthy, and staying sane above all. I know the past few months haven't been easy for anyone. But I would like to say that I do feel very privileged to have spent the last few weeks working on this program and getting to know our speakers better. And I do hope all of you can stay on and listen to all of our panel discussions. At the end of each panel, there will be time for questions, and the speakers will take some time to answer a few of them. The only thing that I would like to say is we would encourage everyone to pose your questions as they arise. There's to the right of your screen and the Q&A section where you can post all of your questions. And then we just have a few additional housekeeping items to mention. At the top of your screen, there is a toolbar for you to navigate through this event. The Sessions tab will allow you to view the panels, ask questions, and chat amongst those in the audience. The exhibit hall will allow you to view the sponsor booths and materials they have provided, as well as engage with them via chat and video. We highly encourage you guys to do so and dedicate some time to stop by those exhibit booths. There's also a speaker section that will provide the speaker's bio and headshot so you can get a better idea of who's who. And in the lounge area, you will be able to view all of the event attendees. If they are online now, they will have a green button on their picture, and you can live chat via text as well as video. And if they are offline, please feel free to send that message over to them and it will be delivered. So we definitely want to encourage everyone to make the most of your time on this platform and to treat this as if it was almost a physical conference, which is hard, but I think we make it a little bit easier. So if there's someone you'd normally say hi to or someone whom you'd like to introduce yourself to, please take full advantage of these tools and connect with each other as much as possible. Your inbox is going to be located at the top right of the page in the drop-down menu. Please be sure to check this regularly as not to miss anything. One more item I would like to mention, there was a survey sent out to a number of our attendees. If you received that survey from us and you haven't filled it out yet, please feel free to just fill that out before 4 p.m. To run any event, live or virtual, it takes, the hard work of several groups of people. So let me take this time again to once again thank our speakers, our sponsors, and everyone that had a role in putting this event together. And of course, we have to thank the team at Opal who have been working so very hard to put this conference on. And of course, I want to thank you, the audience, who have taken more time out of your busier than ever day to join us here today. But with that being said, I think we're going to get started with our first panel of the day, which is where we're going to look at the LP consultant perspective on the emerging manager market. And your moderator for today's presentation is our good friend, Chris Solares. Chris is the managing director of Cliffwater LLC in the New York office and a member of the hedge fund research team. Prior to joining Cliffwater in 2011, Chris was a senior analyst at Sale Advisors, where he focused on manager selections and due diligence as the head of research for tactical trading and relative value strategies. But here to tell you a little bit more about himself and introduce you to the rest of our panelists, Chris, hello. Whenever you're ready, please feel free to take it away. I want to make sure that everyone's mic is working.
I think Chris is on mute.
And then Chris, I think your mic is muted right now. There you go.
Okay. Sorry, guys. Hello, everyone. Thank you for joining us and welcome to the Opal Emerging Managers Virtual Summit. I think it's quite apt to have a panel discussion about how COVID-19 has affected emerging manager programs, because it's been with us for 6 months and has changed our whole world. To help me unpack all of this and more, we have 3 great panelists, Tammy Kesselman, Evan Katz, and Hatin Doshi. And before we start, I would like to have each of them spend just about a minute introducing themselves and their background, and then we're going to kick off with some questions. Tammy, maybe you could say hello and introduce yourself.
Sure. Hi, everyone. For those of you who've come to other Opal events, you probably know me by now. When we had real things, used to chair for the last 4 years Opal's Impact Investing Forum. I'm the founder and chief investment strategist for Aligned Investing Global, and I'm an impact strategist mostly for family offices, wealth advisors, and asset managers, often who don't necessarily have impact in their portfolio yet, and helping them think through and understand how to do it in a way that continues to perform at or above their current performance level financially. And I'm about to be launching Alpha Girl in a Beta World podcast similarly. So stay tuned for that. And yeah, and there's a lot more that I'm on boards of and things, but we can get into that if it's relevant.
Thank you, Tammy. Hatin, could you introduce yourself, please?
Sure. Hi, my name is Hedge Doshi. I am the founder of Doshi Capital Management. We're an emerging manager. We focus on a systematic strategy that is asset allocation. And I'm excited to be on the panel and talk about, how COVID has affected all of us.
Thank you, Hedge. Evan, hi, how are you? You're on mute, Evan. Evan, you're still on mute.
Okay, is better?
Yeah.
Okay, great. Hi, everybody. Good morning to all, and thanks to Opal for hosting. My name is Evan Katz. I'm a managing director at Crawford Ventures. We work with emerging managers in the alternative asset space, principally hedge, but also private equity, venture, and real estate, and about 1,000 allocators who will consider emerging managers, including about 100 or so who focus on them pretty much exclusively. Good to be here.
Okay, great. Well, I think it's safe to say that COVID has amplified and accelerated trends that were already in place. We know all of this. We're all reading the same news, but economic and socioeconomic vulnerabilities, political divisions, digitization. It's amazing that we're having this global panel right now on Zoom. But to bring it to our topic at hand, how has COVID affected emerging manager programs? Maybe we can start with you, Evan. Crawford is a hedge fund incubator and capital raiser, and you're constantly in touch with hundreds of LPs and GPs. From your perspective, how has COVID affected emerging manager programs?
Well, in a myriad of ways. Obviously, in March and April and even early May of this year, everybody was pretty much on hold trying to figure out how to buy groceries and what to do with the kids and how to set up a Zoom and how to find disinfecting wipes and so forth. Since then, we're in what I call the new normal. Basically, what allocators have been telling me is that if COVID were a hurricane that was going to last maybe 1 or 2 weeks and another week of cleanup, they would have just sat on the sidelines waiting for it to be over and then get back to the usual phone call, conference call, meeting, on-site due diligence, and so forth. But what allocators are telling me and have confirmed repeatedly is that since COVID is going to be with us, unfortunately, for quite a while longer, at least to some degree, they are now going ahead with investing. They're not going to be on the sidelines for an entire year or more. So as a lot of people have experienced, it's gone maybe 1 phone call, 2 phone calls, now with several Zoom meetings. They have moved operational due diligence as much as humanly possible online. And everyone is sort of realizing, well, it's nice to meet the PM and the team and shake his or her hand and to see the office and get a cup of coffee while you're there. A lot of it can be done online. A lot of it can be done virtual with data rooms and so forth. And they're getting used to the new normal or the new abnormal. You know, there certainly are certain very sensitive documents that traditionally never left the manager's office. Sometimes they're delivered, sometimes they're held up to a screen, literally held up to a screen on a Zoom call. But basically, they're getting used to the new normal and investing sometimes with managers that they haven't met, or sometimes with managers that they met a year or two ago but haven't seen recently.
Yeah, I agree. That's something we've done. We have moved all virtual. So our investment and operations teams are all visiting managers virtually. On the ops side, it's a little bit tougher because you obviously want to be in the offices. So some workarounds I've seen, you have the COO at the firm doing the FaceTime or Zoom video through the empty office, and then sharing screens and showing some documents that you might only see in the office, at least sharing them digitally. Heaton, you are an emerging manager, and you mentioned to me that you're actually getting you're a lot busier on the marketing side because of the accessibility of Zoom and this digitalization trend. Can you talk a little bit about that?
Yeah, sure, absolutely. So, so with COVID, what COVID has really done for the emerging manager is it's leveled the playing field, right? You no longer have to have that Park Avenue office, to show investors. Everything is being done online. And I think initially there was, some resistance to getting meetings because people are just used to being in person. But, as COVID has persisted, I think, that it's become the norm, and people are starting to realize that that's, sort of the way it's going to be for the near future. And so, a lot of allocators are becoming more comfortable with doing Zoom calls and, and meetings like, online and whatnot, and having that conversation. And so that has really, allowed, at least us as an emerging manager to obtain a lot more meetings with, some of the large allocators or family offices that wouldn't have probably taken, an in-person meeting. And the other thing that's really changed the game for, I think, emerging managers is, COVID has created a recession, right? It created a 35% drawdown in the equity markets. And that has given emerging managers an opportunity to shine. And I think, it's pretty well known that a lot of emerging managers, do better than the big money managers, right? They're a lot more nimble. They have, niche strategies and uncorrelated strategies that can outperform. And so, past 10 years have been in a bull market. It's been hard to outperform an overall market. But now, with the volatility that we've seen, that's really given an opportunity to emerging managers to shine and to really show what they can do.
Yeah, agreed. And Tammy, what is your perspective? How has the emerging manager world been affected by COVID over these past few months?
The challenge of going last when other people cover most of the talking points. So yeah, I mean, agreeing with both, and especially what Heaton was saying as far as accessibility, and now you don't need to have the office, because as long as your background in Zoom looks the same as an established firm, then you are an equal playing field. I think that the bigger thing is that the second point he made about winners and losers, and one of the biggest challenges for emerging managers has been so many fund allocators that are that look for track record, and have always in the past looked at track record of the team that you're with at the firm that you're with, which then cuts out most emerging managers unless they have really strong ties from where they were before. But if they're first time emerging managers, that's been a challenge. And now, because COVID has really anyone that's stuck with their traditional strategy, that's always made money, that's been in hospitality and commercial real estate as a equally allocated part of their portfolio, has really lost to emerging managers who've come on and been looking at health tech and ed tech and e-commerce. So there's an opportunity to shine, where even if it's only in the last 6 months, it's a much easier sell to say, listen, look at what you've done with the people that you've been sticking with. So I think that that's helped a lot, because it's actually leveled the playing field on the other side as far as getting a little bit, knocking out that barrier of track record, of like establishment track record versus actual last 9 months track record.
Yeah, and you know what's interesting? What's been so great from a allocator perspective is all of these virtual conferences. They they can do a really good job of accessibility, right? So you can do the quick meetings, you can do the quick roundtables. You don't have to leave your home office. You can do so much more in a shorter amount of time. And I think they're able to even get, it doesn't take a lot of time for the portfolio managers to take 30 minutes out of their day and introduce their strategy to dozens or hundreds of audience members. Evan, you were telling me your kind of prediction for the future of some of these conferences, how there'll be a hybrid between in-person and digital when the world is normal, whatever that looks like. Can you talk a little about that?
Yeah, sure, Chris. I mean, that's it's anybody's guess what's going to happen in the future, but that seems to be the consensus. So in other words, as we've been saying, and allocators have been telling me now for the past several months, now that everyone's gotten up to the technology and people have built out the systems and everybody's comfortable with them, what allocators are telling me is that it's an extraordinary situation where instead of having to fly everywhere and carve out weeks out of their year to go to 1, 2, or 3 cap intro events over the course of a year, because it's a big to-do and flying and hotels and whatnot, that the situation that we have now is really quite compelling, where you have almost one major cap intro event going on per month between the prime brokers, the private conference companies. And so the opportunity for allocators that are looking for great managers, emerging or not, to meet those managers because they can do so from the comfort of their living room or an office without having to hop on a plane is extraordinary. So to paraphrase Mark Twain, I think that the death of in-person meetings has been greatly exaggerated, but we'll probably end up somewhere in a hybrid model where there will still be plenty of in-person meetings. The hedge fund networking and cocktail party will not be gone forever, but the opportunity to meet a ton more managers virtually initially, and then to follow up with some or all of them in person at some point is only going to facilitate the capital process. And one last thought about what an allocator said to me maybe just a week or two ago, about the need to see the office. Yes, at some point they want to know you have a real office, but as one allocator said to me a few weeks ago, the debacle that was Madoff was not because investors didn't go to Bernie Madoff's office. He had a beautiful office in the Lipstick Building. Every investor went there. That was not the problem. So now that we're getting comfortable with the technology, the pace of capital introduction has picked up appreciably. Well, again, I don't think that the in-person meeting has gone away completely, nor will it ever.
Yeah, I think that's really important. From my perspective, and having the opportunity to look at hundreds and hundreds of managers, I forgot to introduce myself, but our firm is Cliffwater. We're an alternative investment consultant, and we advise about 50 institutional investors on their alternative investments. So we're looking at hedge funds, private equity funds, private credit, real estate. I look specifically at hedge funds, and so this is all on the active management side. And it's interesting how almost all of, basically every GP now has become almost an armchair scientist, epidemiologist in studying the path of this virus, because the pandemic has obviously impacted global growth, and it will continue to impact global growth until we find a new normal. But the monetary and fiscal response to this pandemic is impacting financial markets. I mean, look no further than us being nearly at an all-time high equity market right now in the U.S., despite all these underlying problems with unemployment and corporate bankruptcies and small businesses being affected. So it's amazing how much focus has been not just in our private lives about our health focused on COVID, but even in our professional lives. All of the management within the asset management world is focused on the path of this virus. But that kind of brings us to our next big topic. And what are investors looking for right now? I guess from my perspective, I would say that one of the more interesting things I've seen over the past 6 months is the rise of credit strategies, like the new launches over the past 6 months, probably over 100 new launches within some form of credit, whether it's structured credit or distress. Sometimes they're drawdown funds, so they might be between a hedge fund strategy and a private equity strategy. And the point would be to take advantage of the imminent dislocations in the credit capital structures and the future bankruptcies that are all going to arise from this pandemic. That would be one big theme that I've seen out there. But Tammy, what are you seeing out there? Like, what are investors demanding? What kind of strategies, what kind of returns, from your perspective, what are you seeing out there?
Absolutely. Well, I think one of the biggest things is not a traditional answer as far as what they're looking for, but that I think will shake up a lot is we've talked about COVID, but we haven't talked about racial justice. And because of everything post George Floyd, I think a lot more cap allocators, a lot more investors are demanding that they do audits of all of their vendors, including their wealth advisors, including their managers, saying, what does your team look like? If you have a board or trustees, what is that? What is the makeup of that? What is the makeup of your employees, and what is the makeup of your portfolio, and making sure that there's a diversity lens on each level. So if you're an independent manager, perhaps you can get away with it. But if you have a team of 3 or more and there is no diversity, more and more, I think that managers and others in the wealth space are going to find themselves losing, most especially when there's wealth transfer events. So we know that from 2017, over the next 30 years, there's $30 trillion transferring hands intergenerationally. And as that happens, there's I should know the number, someone on the panel I'm sure does, but it's well over 70%. The wealth advisor relationship ends, that next generation decides, I'm not my father's generation, and switches. And it will be the same with managers. So it's a great opportunity for emerging managers as far as each time there's a generational transfer. But within that, if you can frame it and speak a language of having some lens on climate, some lens on most especially diversity, including within your own team, you'll be able to take different cap allocators away from where they've traditionally gone for a long time.
Yeah, for sure. Keaton, your strategy that you run at your hedge fund is a systematic asset allocation strategy. And I imagine the systemization of it all probably provided you with some comfort during the crisis, because you didn't have to make that tough decision to buy or sell, go long or short. Your models were already programmed to do that for you. What are you finding from what investors are asking for? Are they asking for systematic strategies?
Yeah, absolutely. So, 2 things, at least from our standpoint, we talk to high net worth investors and we talk to, family offices. So that's our bread and butter. And, from the family offices, the first question we get is, how'd you do this year? Right. Going back to what Tammy said, these last 9 months is kind of like where the focus is. And, you don't really have to have that, 5-10 year track record, anymore. And, the family offices, they want to know, how'd you do in March and April, and how'd you do, through the drawdown and the pandemic. And if you've done well, that's where they really care about. Right. They're looking, to diversify their portfolio, and having a systematic strategy. I think that's where the focus is, because you're right. It takes the behavioral aspect out of it, takes the discretionary aspect out of it, where you are now following a model and you're not, impulsive and making decisions, when the market is dropping, 1,000 points a day and whatnot. So that has been, sort of a boon, for us. And then from the high net worth perspective, what we've seen is a shift away from financial advisors, right? All the high net worth people we've spoken to, they're not as happy with their financial advisors, because, financial advisors, they're not as adept as mitigating, downside risk, right? As a hedge fund or an uncorrelated strategy can be. So a lot of the money that we've taken in has come from a shift away from financial advisors and to us. And I think, that'll probably continue, because, as I said before, when you're in a bull market, right, your financial advisor is doing well, funds are doing well, index is doing well, there's this focus on passive investment. And now when you have all this volatility, there's a shift back to active management, right? That, who's going to protect me on the downside? Who's going to make money on the downside, right? And that's not to say all the money is going to go to hedge funds, but people are now starting to realize, wait, what? Part of my portfolio should be, in hedge funds. It should be in something else other than just the index or with the FA or, or some long only strategy or a mutual fund. So, we're starting to see that shift come back to active management.
Yeah, I agree. I think that this is the big question right now. One of the big questions is passive to active. And over this past decade, we've seen this big shift from active to passive. And in hindsight's 2020, that's exactly where you want to be in a bull market. You want to be with the lowest fees and the highest beta. And where we are right now, it's always hard to tell. But I imagine the next decade is going to look much different than the past decade. And this is where you want to be with active management, at global economic turning points, at periods like this U.S. election, period coming up. We're 40 days away from the big election, but who's counting? This is going to be a big deal for volatility in the market, and this is where old hands that are used to trading these types of environments will come through. One of the big questions that our clients are all grappling with is what to do with their fixed income allocations. The U.S. 10-year right now is at about 60 basis points, and with negative real yields, it's still there as a hedge in the portfolio. There'll still be a flight to quality if we have another big down leg in the market, but the carrying cost is so low. It's a negative real yield. So it's been a great, the 60-40 portfolio, having any kind of fixed income has been excellent for the past 30 years, but the next 30 years will look very different. So my bull case is that what we see is a shift really from passive fixed income into active hedge funds, because you could imagine, you could put together a hedge fund portfolio that's actually low risk, despite some of the managers having idiosyncratic risk. It will be a low risk portfolio. It will have a modest carry, almost a fixed income like carry, single digit returns. It'll be diversified, and it will be able to hold up within all types of environments, including one of a rising interest rate environment. So that's kind of big picture from me here. But Evan, you're thinking a lot about this, and you're talking with a lot of managers. What are the strategies that LPs are demanding from your side in this, basically low interest rate environment?
Sure, Chris. What we're hearing from our institutional and family office investors is obviously everyone can throw darts in a bull market and look like a genius. With what's gone on this year, everybody's woken up and realized again that, what did Warren Buffett say? No one knows who's swimming naked till the tide goes out. That now we're in a real situation where you can't just throw darts when there is this choppy volatility. And so investors are telling us they're looking for just top talent, whether it's sort of the global macro themes you said and bankruptcies. The opportunities are certainly going to be there. Rothschild said you buy when there's blood in the streets. With what's going on, there's absolutely, from a global macro standpoint, opportunities for bankruptcies and restructurings and things like that, but also managers that are in niche strategies that are less correlated or non-correlated. A Crawford affiliated fund was actually up 23% in March of this year when the markets were down. I think it was roughly 15%. And if that doesn't show that someone's doing something right, I don't know what will. Whether to the point too about emerging managers, the topic of the conference and the topic of this panel is that, as you said, studies show that emerging manager hedge funds do about 100 to 300 basis points more a year on average, exceptions in every direction. And we've done a study on this and have confirmed the same thing. So, this is, if ever, a time to look at emerging managers who do tend to outperform. And in terms of women and minority managers, there was actually an interesting talk that I gave a couple of months ago, looking at how women run hedge funds and how women run countries. And the interesting point from the data was that studies show that women-run hedge funds tend to and can outperform in general, and specifically have less tail risk, fewer blowups than men-run hedge funds. And again, exceptions in every direction. And the studies also show that women-run countries have handled coronavirus on average better than men-run countries and have been more sensitive, appropriately sensitive, to the risk of coronavirus. So we did a study actually comparing the two and showing that, again, these are averages and there's exceptions abound, but that on average, women's heightened sensitivity to risk, appropriately so, actually reduces hedge fund blowups and also has resulted in countries run by women handling coronavirus better. So interesting point for those looking to invest.
Yeah, and this again is a testament to diversification across gender of your PMs, across emerging managers versus experienced managers, across strategies, across asset classes. I guess diversification really is the only free lunch in finance these days. We have a question for the audience. I'm going to turn it back to you, Evan. What's the importance of hiring a fundraiser to help emerging managers during this time? Like, how will this help emerging managers specifically launch their funds?
Sure, Chris. Yeah, well, at the risk of talking one's book, it could never be more important. And there's a lot of great fundraisers out there, but experience has shown that it's always critical to have a fundraiser who knows the investors for 5, 10, or 15 years. We've seen countless PMs try to reinvent the wheel and start dialing for dollars on their own from scratch. And the hit rate, the success rate is orders of magnitude less than if you have someone who already knows the investors and is on a first-name basis with them for a decade or more. And I think it is definitely more important, especially in the time of coronavirus, because what we're hearing from allocators, institutional family offices, and so forth is that, sure, we can do Zoom calls with anybody, but we're still getting hundreds, if not thousands, of pitches a year. And I guess, Chris, you're in a similar situation. And if you've got a stack of pitches coming in from around the world, and which are the ones that typically get read or that get read first or that you end up having meetings with, it's from somebody who and you don't have the time to read the rest of them. So I think especially now in the time of virtual meetings, make sure that your fund has a fundraiser who knows the investors on a first-name basis for a decade or more, because while you can do virtual due diligence and video meetings, getting those meetings is going to be orders of magnitude more likely if you are working with someone who already knows the people versus cold calling or cold emailing everybody. It's a good question and a good point.
Yeah. Hayden, what would you say to this? If you were giving advice to an emerging manager or even to yourself when you were really just starting, what are the lessons learned?
Yeah, so there are a lot of lessons learned. I could probably fill the rest of the time with that. One of the things that I would say is, when you're starting out, pick quality service providers, right? It's easy to just go for whoever is the cheapest, right? Because you may start out with small amount of money, you may be able to afford the larger service providers. But what I would say is stick with quality, right? In the end, that'll serve you better. In the end, it'll make the fund look more legitimate. It'll lead to less headaches, and it'll lead to the fund and the emerging managers prosper many years afterwards. So that's definitely one of the things I learned. One of the mistakes I made when I first started out. I just went through and the other thing is also find someone that can help you ask the right questions, right? Me, I didn't have an operational background, right? I had a trading and a background, and so trying to find an admin, a law firm, an auditor, right? You have to learn what are the right questions to ask to find the right service provider and the right team that's right for you as well, right? It's not just going for the most expensive either. It's going for the best bang for your buck. And so I think that's really important when you're first starting out. Yeah,
I always have two pieces of advice for emerging managers, and the first is usually if it's the CIO, to hire someone to take care of everything else. A CEO, it's easier said than done, and there's budget constraints sometimes, but it's hard to do everything. It's hard to be fully committed to investing and take care of everything. And then the second one is a little tongue-in-cheek, but get lucky, because you're going to be judged on that first year of track record and the second year of track record. And after 2 years, almost nothing else matters, because there's so many emerging managers out there. A lot of it has to do with performance, for better or for worse, risk-adjusted performance or absolute performance. So I think that there's a little bit of luck involved as well. Tammy, I want to turn it back to you, because you have talked a little bit about ESG and diversity, and you are on impact councils. And can you tell us about how this is, the intersection of impact investing and emerging managers?
Yeah, absolutely. And I haven't spoken for a minute or two, a couple rounds. So I want to touch on what both Heaton and Evan have been talking about, specifically related to that. So first of all, and Heaton was talking about as far as trusting hedge funds more than financial advisors, but in part because they have a model and disciplined strategies versus discretionary. I think that one of the advantages that people find, one of the reasons for the added basis points of return with minorities and women and emerging managers in general, is because in order to put together your model, there is some discretion that goes into that. So ironically, it is the discretionary aspect of creating a model now and coming out now and not having that 20 years of knowing how the market always was and what always performed, and having a battle tested model that's always worked and to your point, Chris, on the bull market, but this isn't that. So coming in and starting fresh and creating a model now and then sticking to it, yes, but it's actually that discretionary aspect and that lens of, and especially like having the diversity of thought of women and minorities in the mix, and how do you create a model, because there are different forces at work than there ever have been before, and there are forces that aren't going away in the next 2 or 3 months or the next 12 months or 36 months. And then similarly, separately on that, on impact, is touching on something else that was said about the fundraiser relationship that you were talking about. With, you have this huge stack of you know, submissions, and having that fundraiser relationship, you're always going to pick up the call for that as a capital allocator. Well, one of the things, going back to my earlier comments, that I do think over the next 12 months to 24 months, managers are going to get asked, how are you deciding what to review? Or cap allocators rather are going to be asked, how are you deciding what to review? Because that is part of the system. And I don't mean to beat a horse, but this is kind of the lens to think about new opportunities, right? How are you deciding that stack? And if you're only going to people that you already have a relationship with, and those all happen to be white men, then there's a systemic issue, right? That you're not intentionally cutting out women and minorities, but by always going to only what you know and what traditionally was in the market. And so I think that there's going to be more audits of that, actually, which again, whether it's audited or not at first, if you can express how you're looking differently and you're making sure that you're reviewing a broader array of things that are coming to your desk, you can actually communicate that and get people to think, oh my gosh, I didn't realize that, I better look at that also. So you can actually educate the market as an emerging manager, and if you have a fundraiser that you're hiring, ask them questions and make sure that in what they're pitching and who they're pitching out to, that they have that lens in mind. And then I saw that there was a question from John on climate, and I mean, look at the wildfires in California, right? So climate is going to substantively impact both public and direct alternatives. So you want to have that lens and know that you're reviewing, especially if you're looking at things that aren't just a day trading hedge fund, but that have, you know, 12 months perspective or more, that there's probably going to be a carbon tax in the next 3 to 5 years or less in Europe, and something carbon signaling in China where they couldn't breathe until everything shut down. And that's going to show up on balance sheets. So depending on how actively you're trading, you want to make sure that you're expressing that you have a lens and understanding the trends that are coming that are going to be permanent and continue escalating.
Yeah, for sure. And climate change is one of the macro themes, one of the super themes that has really come to the forefront. And again, I think COVID has been an accelerator of these trends. We've been talking about ESG, we've been talking about climate change, and now we're seeing it very vividly. So I think these past few months has been specifically for climate change, like approvals. I don't think it necessarily has been great. People are really just collecting their portfolios and figuring things out. But I think like probably from here going on, it was kind of putting out fires in your portfolio over these past few months and thinking about opportunistic investments. But climate change is absolutely some of the themes that public pension funds are doing, specific family offices that are, you know, that have an inclination because that's part of their ethos. And endowments and foundations are often doing a lot of type of ESG and climate change themes. A lot of times they'll have a bucket, they'll have an earmarked bucket. And in the most extreme cases, they'll have a mandate for every single investment to be somehow to be, you know, ESG compliant. Evan, are you seeing much on the climate change renewable side?
Sure, we're seeing a lot on the private equity side of things. Some of the fundraising deals, projects, and PE funds we've gotten involved with most recently have involved clean technology, everything from energy from waste to solar and so forth, because there's clearly an understanding at this point that the opportunities there abound. California, you may have seen, actually I think it was just yesterday, came down saying there will be no more new gasoline-powered cars sold in the state of California 15 years from now in 2035. So on the private equity side, we're seeing a lot more of that. But Chris, real quick to your and Heaton's point about the advice for emerging managers, further to your point, just to put a finer point on that. One of the things we always tell emerging managers is this. The good news about the hedge fund industry is you can get in with 2 guys, a gal, a dog, and a Bloomberg. The bad aspect of the hedge fund industry is that you can get in with 2 guys, a gal, a dog, and a Bloomberg. The point is this. While you can set up your hedge fund on a shoestring, you can get to first base on a shoestring. You're not going to get much past first base on a shoestring. So the lesson is this. Commit to your business. It is a business. So Chris, if you or I were opening up a store or a restaurant, we know we got to put in a couple $1 million to build our store, build our restaurant, and so forth. It's the same thing on the hedge fund side. So when Heaton talks about great service providers, sometimes we hear from people we can't afford them. And when someone says, well, you should have a great CEO, like you said, Chris, or a great CFO, and the manager says we can't afford them, that all comes back to this is a business you have to invest in it. So if you're launching a hedge fund or building a hedge fund or growing a hedge fund, in addition to whatever AUM you have on the LP side, you want to make sure you have at least a couple of $1 million of operating capital to get the great service providers that Heaton talked about, to get the great CEO or CFO that you spoke about. And if you're not willing to put that money in or you don't have it, then the best kept secret I found is, if you're the PM, go to your family and friends who know you forever and raise a couple of $1 million and sell a piece of your GP, a piece of your firm, so you can hire the great service providers, so you can hire the great fundraiser, so you can hire the great CFO. And it's much better to own, call it 80% or 70% of what becomes a $500 million or $1 billion fund than it is to own 100% of a $2 million fund. So, the lesson is if you don't have the operating capital, don't get in the business or raise it or spend it or invest it yourself.
Yeah, thank you, Evan. I completely agree. We have one more question from the audience. It's for Heaton. Can you see this, Heaton?
Yeah,
the big picture. Yeah, big picture is how did you do during the first half of the year, and what are your views for the upcoming volatility of the election season?
Yeah, absolutely. I appreciate the question. So, as of end of August, our fund has been up 137%. So, we've done well, and that's part of the systematic portion of it, right? When the markets were going down in March, we stuck to our guns, we stuck to our model. We made money on the downside, and then we made money back on the upside, right? So, that goes back to getting away from the discretionary, that behavioral aspect. When the markets were dropping, a lot of people were pulling their money, out of the markets. And then as it was ripping back up, everyone was sort of scared to get in. So you kind of get hit on both sides. And then, coming with the elections coming, we've already seen a 10% correction, right? Just over the past week in the market. So I think that right there tells you that there's going to be a lot of volatility ahead of the election. Going back to, I think what you said, Chris, there's so much uncertainty still out there. And it was amazing that we were at all-time highs again, right? With no stimulus on the table, with with COVID still spreading across the globe, with elections coming up, with the current regime saying that they're not going to willingly step down. There's wildfires in California and smoke spreading to the East Coast. There's just so much going on, and markets were ignoring everything, just from Fed stimulus and hopes of a vaccine, right? Like those are the only two things that matter to the markets. And I think as we get closer to November, people are going to realize that there's more out there than just those two scenarios. And I think we're going to see choppy waters, at least up into the election. And then who knows what happens after, right? If you have a Biden presidency, that's higher taxes, right? If you have a Trump presidency.
But more world stability.
Yeah, absolutely. Absolutely, right? Absolutely. Not to get into politics, right?
But just objectively.
Right, objectively, markets care about taxes, right? And so, who knows what's going to happen come election day. So I think it's going to be pretty choppy, for the next month or so.
Yeah, and remember the wild card is still the virus, because even with higher taxes, if we have the Fed ramping up liquidity, that will just overwhelm the markets. That's why we're seeing all-time high markets. Really, is because of it's been the expansion of this balance sheet. Fundamentals don't matter, clearly. But I think that's almost, we're almost out of time. So I'm going to say thank you to Evan and Heaton and Tammy for joining me today. And thanks for everyone for joining in. You've got a great day ahead of you. So thank you very much.
Thank you.
Thanks.
Thanks, everybody. Great to be here.
Chris, Tammy, Evan, and Heaton, thank you so much for being able to come out and speak for us on this topic. I know the audience definitely appreciate it, and there was plenty of questions coming in. If anyone has any direct follow-up questions for our panelists, please feel free to reach out to them via the, the messaging features on the virtual platform. We're going to take a quick little networking / transition break right now, and we're going to be back at 10:50 a.m. Eastern Time